Hello and welcome to our economic reality of 2016. Now, to give you a little bit of background, I created this in order to keep everyone informed on what's going on in the economy. Part of my business is that I'm a financial advisor, as well as being a licensed real estate broker, loan officer, and a bunch of other things that are all related to credit and finance, and helping people achieve financial goals that they once thought weren't achievable. I created this not only for the general public, but for my fellow colleagues in the industry that is related to real estate. Now, the first thing that I want to cover is that we have to be cognizant of what our history is. We had the big crash in 2007, 2008, and obviously many before then. What we have to understand is that we have to know what caused those things, what were the signs, what led up to them, and we have to learn from our history in order to avoid repeating it. Now, in order to do that, is we've got to know our reality. We have to know where we stand. And just because you don't transact or deal with certain aspects of economic indicators doesn't mean that it's okay to be ignorant about them. We deal in an economy that is so intertwined globally, locally, and with other industries that you can't afford to think that only things related to real estate should be important to you. See, you have to understand the data and you have to know the meanings behind it. Now, we know what caused last time's crash, but could that be the only thing that would cause the next crash? No. So we have to be, again, aggressive and not passive when it comes to being hungry about learning on what's going on with our world. And then once we figure out how to interpret all the data, we have to be creative in creating solutions. There isn't a one size fits all, and we can't just all flock to the local best seminar or book that's going to give us a one size fits all solution that we try to implement on everybody that we interact with. It just doesn't work that way. Now let's talk about news. The first thing that I need everyone to understand is that there is no such thing as good or bad news. News is just news. It's okay to get news. If you plan and prepare for it, then it can benefit you. If you don't plan and prepare for it, then it's just news that leads to bad things for you and your business because you didn't prepare for it. So let's talk about America's wealth. 77% of it is concentrated within those who are 65 and older. These individuals, mostly all of them, lived through the Great Depression. And most people would assume that just because they lived through the Great Depression, that they wouldn't have any wealth. But it's the complete opposite. And the reason that it's the complete opposite is that they learned a couple of lessons while growing up through the Great Depression. They learned that in order to be wealthy, you didn't have to be a good investor, you had to be a great saver. And the other thing that they learned that we as a society and as countries and individuals haven't learned is that they learned to live within their means. Now, living within our means isn't something that's socially cool, I guess you would say, or something that most people promote. You don't see that being advertised and taught in schools and everything else. Unfortunately, we're a world of excess, and everybody wants more and more of what they don't have and can't afford. And it translates throughout all the countries. It's not just the U.S. And if the countries aren't living within their means, how do they expect their citizens to do so? I mean, they have to lead by example. Now, let's talk about the history of bonds. Back in the 80s, if you wanted to generate $50,000 worth of income to live off of, all you needed to do was have $350,000 in cash that you can invest in U.S. Treasury bonds. The reason is because back in the 80s, U.S. Treasury bonds were paying in the low double digits rates of return. Now, today's reality, you would need $2 million in long-term Treasury bonds to generate $50,000 worth of annual income. You would need $2.5 million if you wanted to do it using a CD account. And if you just wanted to be able to do it with money in your savings account, you would need to have a good $4.5 million to generate that kind of return. Now I know we're all thinking, well, only the 1% has that kind of money. And you're probably right, because the reality is that 99% of America does not have substantial enough assets to even generate a $50,000 a year rate of return that they can live off of. And what's even sadder about that is that $50,000 doesn't get you anywhere. Now, I know everybody's been talking about, well, is there going to be a crash? No, there's not. Yes, there will. When will it happen? Well, nobody knows. And I'm not here to tell you that it's going to happen on X date, but I am here to tell you that all the signs point to that it will happen. Now, the question is, would you rather be too late or too early when it does happen? Let's give you an example of Brexit, when the UK left the EU. The stock market in the United States dropped 1,300 points in the 2 days following. Now, did your financial advisor call you and say, hey, pull your money out before this happens, or before this potentially happens? Did you get a letter from your employer stating that, hey, they were going to remove everybody's retirement money from the stock market just in case the volatility goes sideways? No, I can almost guarantee you that they didn't. So by the time that it happened and you found out, before you could do anything, guess what? You were too late. Now, if you were, I don't know, cautious or proactive, and you pulled your money out knowing that you were paying attention to what's going on in the world, knowing that this vote was coming, and you pulled out too early, and the UK didn't leave, and the market rallied, and there was gains because they were celebrating that the EU was staying intact, then you would have pulled out too early and you would have missed out on that. So again, the question is, would you rather be too early? Would you rather be too late? Or would you rather be positioned in a position where no matter when it happens, you could take advantage of it? Now, I know most of you are probably thinking, well, what does it matter? The stock market only dumped for 2 days and then it came back. It matters because of the reason of why it came back. Again, it goes back to the data and understand what's going on and what's our reality. Now, the governments knew that this was a potential hazard, that this might happen. So they prepared for it. Again, they understood that this was just news and they were going to be prepared for it. How did they prepare for it? They set aside $500 billion so that when the market did take a dump, they came in and flooded the market with cash. So it only took 2 days to release all that cash and get the stock market back to where it was. So again, it goes back to news is just news. And if you're ready for it, you can benefit from it. And if you're not, it'll hurt you. Now, is this the first time that they did this? Was this the first time that they manipulated our markets? No, they've been doing it for the last 9 years. And the reality is that we haven't gotten any real growth for all their manipulation either. Let's go over some numbers. Now, on January 1st, the Dow Jones was 1094053, somewhere around there. In August, the Dow Jones was 1854716, around there. Now, if you did the math between January and August, you would see that the rate of return was somewhere around 4.21%. Now, if we said that corporations were paying about 1.2% in dividends for their shares, then the only amount of return you could expect is about 5.41% since January of 2000. Now, why does this matter? Because most people look at the big number, the 18 plus, and think, wow, look how far we've come. But they don't really pay attention or cognizant of what the real return is. They just see when the market rallies, they, ignore it when it drops and just hope for the best, but they don't really do the math. Now, 5.4% isn't bad, but if you were positioned in a different way than just being in the stock market, whole hog and all in, you could have taken advantage of the downs and you could have killed that 5.4. That would have been nothing compared to what you could have gotten. Now, everybody wants to know, should we buy, when do you buy high or low? Well, obviously the rule is you buy low and you sell high. But when is it going to be low? Who knows that? Nobody does. Nobody has we know that nobody has a crystal ball, and we all know that there is signs that we can look that can potentially cause a downturn in the market, but nobody can tell you for sure. It's a big guessing game, and guessing is how people become broke. Now, if you position yourself correctly, you could take advantage of the downturns and enjoy the recoveries, and then put yourself back into a position that you're in safe territory. It's all about knowing how to place your money and knowing how to be proactive instead of just passive. Now let's talk about the S&P. The rate of return from 1999 till now was 2.76%. That's not that good. From 2007 till now, it was about 4.51%. That's better on the shorter term, but again, it's like, when do you get in? When do you get out? When is it going to be good? When is it going to be bad? It's just a guessing game. Now let's talk about the NASDAQ. From 2007 to present, it's been about 9.81%. So it kind of killed it. However, but since 2000 to present, it's been about 1.91%. I mean, that's not some very good returns. So let's talk about the golden rule, buy and hold. This is the best strategy according to everybody. But again, if everybody knew when to buy and how long to hold, then nobody would be broke. Again, it's just a guessing game. All you can do is manage the crazy. The market's biggest boogeyman is volatility. But you can manage the boogeyman if you're positioned correctly, and you can make the boogeyman work for you. Now, this again means to be active, not passive. And you have to focus on, not just buying this one stock that you swear is going to pay for the rest of your retirement, everything you ever needed, because this is some magical stock. It doesn't work that way. You have to be knowledgeable. You have to be wanting not crazy returns, but just focusing on zero risk. That's where we have to change our focus, because the market has changed. And in reality, if you're trying to grow your wealth, the most important thing is to position yourself where you're not going to lose money. Now, why are we in a mess? Well, we can't expect double-digit returns, like I said, when the following are the facts. If world growth is about 2%, and realistically in the U.S., it's hovering around 1.6%, inflation is at 2%, which, again, it isn't, even though countries are printing money like crazy, and productivity was at 1%, then the best rate of return you could expect is 5%. But yet you got everybody out there wanting double-digit returns. Now, what happens if you make the wrong choice? The honest and most realist answer is that if you time things incorrectly, you're going to get hammered. So be different. Don't believe the hype, and do things that are going to stabilize, and secure your future. Stop focusing on impossible gains. Focus on the rule one of investing. Don't lose money. Take control of your money. Expect real returns. Now, what are the experts saying? Because there's people who do this and pay attention to this a lot more than even I do. And I would say that I pay attention to these type of statistics and data more than most, especially more than probably most of the real estate agents. And that's not talking down about our industry. It's just our industry is so crazy that unless you make a concerted effort to be involved in anything else, our industry has a tendency of being all-consuming. Now, Jeffrey Gundlach, who took over for the bond king, Bill Gross, says sell the house, sell the car, sell the kids, and get to safety. Mark Faber thinks that the S&P is going to dump 50% down to the 1100 range. Harry Dent expects that says that you can expect to lose about 1.5% for every year for the next 10 years, totaling 20% of your assets are going to be depleted. You know what else is scary? Is how much the market has been manipulated. See, the companies and the government have been playing with the market and providing us data that isn't really factual. And how they've been doing this? Well, for the corporations, they changed the way that they do their accounting. The standard and widely accepted accounting principles of GAAP accounting aren't being used. They're using non-GAAP accounting. And what this does is this allows them to expand the way that their profits and assets look. So to give you an example on how it works, if the S&P uses non-GAAP accounting for 2015, it shows that their rate of return per share was around $118. Now, if they use what used to be the most widely acceptable and respected form of accounting, which is GAAP accounting, it would show that they only actually returned $87 per share. And again, these are statistics based off of the returns for 2015. And again, that's the example of how corporations are doing whatever they can to inflate the numbers so that we don't see what really is going on. Now, I don't know how many of you have looked at the website where the U.S. debt clock. Well, the reason that I'm going to this site is I want to show you guys that it's all this information's out there and it's being put out there by the government. It's just we don't take the time or have the desire to see it. So on this website, you can go down there and you can see that they're expanding the money supply by printing new money. And they've done this over 530 times since 2000. Now, why would we do this? They want to increase inflation and liquidity. But things are so bad that we're not seeing inflation yet. We're actually seeing deflation in a lot of industries. Now, are we the only country doing it? No. Japan has printed about 1/3 of their economy. 30% of their growth is due to the economic stimulus that their government has dumped into the market. China is printing like crazy, and most analysts say that it's the worst debt and real estate bubble that anyone's ever seen. South America has the money printers on overtime. That's how they were able to pay for the Olympics. And even with printing money like crazy, they were still having trouble getting things done. The EU prints currently about $1 trillion a year. Now, everybody's wondering, show me the money. What are they doing with this money? Well, we're the only country, or one of the few, that is still paying positive returns. Even though they're crappy, they're like in the, below 2% for our treasury bonds, we're still in the positive. So what are they doing? All these countries, instead of using the money in their own economies, they're putting all that money into our market, which is inflating it and obviously giving us a false sense of security, because if they put it in their markets or in other markets, those places are paying negative returns. Now, why should we care? It's because what happens with all this fresh cash? It's giving us fake returns. These aren't. This isn't real growth. This is all inflated and, you know, fabricated growth, and it's all going to end. One of the other things that's good to know is around 378 of the companies in the S&P 500 are actually buying back their own stock. Now, why is this important to you? Because guess what? It's another tactic that they're using to inflate their stock prices and to make more money. Now, most companies, when they make money, what they do is they invest it in capital improvements and employees, expanding programs, whatever it may be. But no, they're just squirreling away the cash and making a few people who are already super wealthy even more super wealthy. Now, recently, a CBO report, this is the government, said that 90% of the returns that are being experienced in the market right now by corporations are due to the stimulus money that the government's dumping into the market and that other governments are dumping into our market. And another 40% of it is due to their inflated stock prices due to their buyback, their stock buyback programs. Now, I know 90 and 40 makes 130, not 100. That's just to show you that we're living in a fantasy land. Now, the greed has gotten so bad again that instead of just waiting until they make money to buy back more of their stock, they're actually taking loans to buy back their stock to increase their stock price. Now, what about the jobs report, right? The numbers that are being reported, well, in all honesty and to be frank, they're crap. There's different ways to interpret the data, just like anything else. There's the U3, which is what's used, which is the most forgiving matrix, and then there's the U6, which is a little bit more realistic, and then there's other ones that take in even to more factors. The government uses the U3. Again, it's the most forgiving. So right now, using the U3, we have an unemployment rate about 5%. If you use the U6, which takes into more factors into consideration, we're around 12%. And if you use other models that take in even more factors, a lot of experts say that we're actually at an 18% unemployment rate. Now, when they say that X amount of jobs are seasonally adjusted, that doesn't mean that real jobs were created. They're guessing. Those are just a hypothetical or an educated guess of how many jobs. So it's not like those jobs were actually created. Now, what the U3 and the U6 and how they vary, what I'm doing is giving you guys an article on that tells you in more detail. But the short version and a lot of the controversial reasons that a lot of people get upset with the unemployment rate is that if you're unemployed for an extended period of time, after a while you drop off and you don't count as being unemployed. Now let's talk about money market funds. And I'm not just talking about money market accounts. I'm talking about mutual funds as well. Now, traditionally, they've always reported that and said that their shares are $1 a share and they'll never go below $1. Now, in the last crash, the shares did dip below $1. And what they did is they had to take some of their own assets and put them into their own funds to bring that back up to $1. Now, in July of 2014, the SEC changed the rules. And how they changed those rules was they first said that money market accounts didn't have to guarantee you that your share would be $1 as long as they reported it, and it could be a floating number. So if you dump $100,000 in, they could say, okay, we guarantee that it'll be 90% of that. So you dump 100,000, you automatically lose 10%. Now, how else did they change? Well, they also changed that the government said, okay, you can stop people from cashing out if the market gets really bad and you're losing a bunch of money. They can prevent you from redeeming until they feel that it's okay and they have enough money to give you your money back. Now, I know you're probably thinking, well, I don't invest in mutual funds or I don't have a money market account. Guess what? Look at your 401k statement and see where all your money's at. Now, does this mean that all money market funds are bad? No. There is still good money market funds. But they have to be a U.S. money market account. Why? Because the U.S. is always they're never gonna default on their debt. They're always gonna pay them. So make sure that you're invested in a money market fund that is heavily weighted into U.S. Treasuries and U.S. securities. Now, if the sky's falling, why are people running for shelter? I'm sure that's what everybody wants to know. There's a saying it's called normalcy bias. And there's a story that if you put a frog in a pot of water and you turn up the water slowly and you do it slow enough, it'll never jump out before the water starts to boil. What I mean by the story is that people just can't fathom that as bad as it got, that the government would let it happen again, that things would just happen again. People would rather believe that no, everything's going to be okay. It can't get worse again. And people would rather avoid being poor than risk being rich. And why I bring that up is that's why there's governments issuing bonds or securities that that are paying negative rates of return. They rather lose a little and be guaranteed that that's all they're going to lose than to risk losing everything. Right now there's somewhere around $13 trillion in negative yield bonds. So remember, there is a boogeyman and there are zombies and they're coming for your money. So what should we be focusing on? Safety and liquidity. Now maybe you think I'm making this up. Maybe you think I'm just, a financial advisor who wants to scare people to move their money and have me help them, or it has nothing to do with that. It's being written about everywhere. And there's all kinds of articles from all kinds of different sources, including governmental reports that are telling you these truths. They're just not promoting them. One of the good articles, and we'll include the link to it, is why I'm closing my bank accounts while I still can. And the next one is U.S. ends bank bailouts and will seize your assets to bail out the banks, something like that. Now let's talk about the G20 and what happened and what became law. Now, on November 16th of 2014, there was a new law that came in place. It's a long word. It's the adequacy of lost absorption law, and it's longer than that, the title is. But what that does is it changes the way it changes the rules to the game. And it's already been used before in Cyprus, Italy, and Greece. So what they do is they say what used to be called the bankruptcy, they're calling it resolution proceeding. And what it does is it turns an insolvent bank solvent again by taking its unsecured liabilities and turning them into assets. Now, what that means is that their liabilities are your deposits. So if they turn them into assets, they turn them into stocks. So now what that does is it prevents you from getting to your money, or it'll make you lose all your money. And I'm sure you're probably thinking, well, what about the FDIC? I'm insured. Not if a bank, if the government implements this rule, because if your money's turned into stock, then the FDIC no longer covers you. The way the government looks at it is that too big to fail banks must be kept open at any cost. And yes, at the end of the day, that means us, the taxpayer, are going to foot the bill again. So let's talk banks. The top 5 banks control in the upper 70% of all assets. Now, you would say that means that they're in good positions. Well, let's look at the numbers. Combined, the top 5 banks are on the hook for $250 trillion in derivatives. Their assets, however, are only $10 trillion. That means only 2.5% of those derivatives go sideways. You can call it a day. They're done. Now, will the banks fail? No. Why won't they fail? Because they'll be bailed out. And they're going to be bailed out by 1 or 3 ways. Tax the heck out of everyone to bail them out, print a boatload of cash to bail them out, or put the G20 rule into play and take your deposits. Whichever one you think is most likely, however, none of them are a good sign. Now remember I mentioned something about negative yielding bonds earlier. Well, in February, there was only, in February of 2015, there was only 3.3 or so trillion. Now, in August of this year, there's like 13 trillion. And most experts are saying that it's going to go all the way up to 15 to 20 trillion. Now, why would people buy negative yield bonds? Well, some people, again, would rather have a guaranteed known loss than an unknown risk. Other people actually think that they might be able to make money by owning them. See, if rates go up, but the value of bonds goes down. If rates go down, then the value goes up. So people are hoping that rates are going to go down. So they hope that they go down even further into the further negative range. Right now, they're like, if you have a bond that's paying negative 0.5%, they're hoping that it'll go to negative 1%. It's a gamble. Forbes just did an article saying that people could lose up to $3.2 trillion in what used to be called safe governmental bonds. Now, quantitative easing is what the government was doing to manipulate the market to prop up the economy. Now, according to Kyle Bass, a fund manager who had dinner with somebody from the Fed, said that quantitative easing only works if you're the only one doing it. But guess what? The whole world's doing it. So let's talk about what happened in the last crash. 87 billion in credit default swaps that failed almost took down the entire global economy. Where are we at today? $1.4 trillion in student loans are outstanding, and 1 trillion of them are expected to default because they were given to students who went to online universities and got degrees that are not giving them degrees and careers where they actually can pay back those loans. $1 trillion in auto loans are outstanding, and 80% of those are considered to be subprime and subprime loans, which they expect to default. 1.7 trillion in junk bonds are out there that need to be paid back. Now, the majority of those are to the energy industry, specifically the oil industry. They borrow this money for fracking and sand drilling and all these other experimental things. Well, the only way that they can pay all their investors back is if oil got to be $80 to $100 a barrel, and right now it's floating somewhere around 40. Credit card debt is around $1 trillion, and they expect all of it, or the majority of it, to end up in default. So we have over 5 trillion in exposure of things that are going to be defaulting. That makes last crash nothing. Last time we lost 12 million jobs. They're predicting that this time it could be upwards of 20 million. Now, why aren't we seeing inflation if everybody's got the printers on overdrive and just printing fresh cash day after day? But because things are just that bad. It's like trying to hold things together with tape. It might hold for a minute, but eventually it's gonna give. You can only put so much tape. Now, in the real estate industry, everybody says, well, hey, the market's still good, blah, blah, blah. That's fine. It may be good, but remember, our economy in the real estate industry is not just based off of real estate. We're seeing deflation, and we're in a bubble, and it may not be a bubble of real estate, but it sure as heck is a bubble. You know, and we have to be aware that this bubble is going to bleed into our industry, and we have to be prepared and prepare our clients to be repositioned. This doesn't mean that real estate is a bad investment and you're going to not be able to sell or buy real estate. There's great opportunities that are going to come, but you have to understand who is good for these opportunities and who isn't. I heard training that somebody was broadcasting live the other day that said the economy doesn't dictate your client, it just dictates your type of client. So, you know, it's as bad as this, that in 2007 the world was in debt for $137 trillion. Well, they went out to printing mode and we went into debt, and now the world is in debt to 300 trillion. The US is on the hook for about 20 trillion of that, and our annual production is about 8.5 trillion. Now, everybody says, well, if it gets bad, we'll just borrow money from China. Well, let's look at where China stands. They owe about 40 trillion, and their economy only produces about $10 trillion a year. So we're borrowing and relying on a country that owes twice as much and produces half as much. Now, I know you're probably wondering, well, why are businesses still spending? Why are new stores still popping up? Well, money's free. They're getting 0% loans. It'd be silly of them not to take advantage of them. They're building, spending with cheap money. It's cheap to service that debt, and if they can't service the debt, they figure, well, the taxpayer bailed us out. They bailed out the auto industry. They bailed out AIG. They'll help us. Right now, corporate debt is at 51 trillion, and they estimate that by 2020 it'll be 75 trillion. It's crazy. Now, John Muldoon, who puts out a newsletter, quoted a study that was done by the government, the CBO. It says by 2019, our revenue will only cover entitlements, defense, and interest payments. By 2023, it'll only cover entitlements and interest. That means we're going to have to borrow for defense and anything else we want. Some more scary stuff. Before, 40 to 50% of Americans were covered by defined pension plans. Now, we're like at 20%. And that's not even a real number. The two biggest pension plans in California are CalPERS and CalSTRS. Last year, their rate of return was only 6 1/10%. That's 6 1/10%. They need a rate of return of 7.5 for the next 7.5 in order to cover their obligations. They're a little short. 5 out of 8, according to the numbers, 5 out of 8 corporate pensions are getting negative returns. So now people try to pretty up the numbers just like Wall Street when it comes to pensions. They're trying to say, well, we only owe X amount of dollars, right? But they don't tell you that Every year that they don't hit their numbers, that increases their debt. That increases their obligations. So they're telling you the numbers, expecting that they're going to hit a 7.7 rate of return over the next 13 years. And obviously from last year's numbers, they're not. And from all the other numbers that are out there, they're not. And how are they going to get 7.7% when the market since 2000 is only given like 5.4%? So what happens if they don't meet their numbers? Again, here we come, taxpayers going to write a check. So, you know, this is all connected. And we have to understand that. The other scary thing that's out there that we're having to deal with is healthcare and all the changing things that are going on with it. We spent 3.3 trillion or so a year on healthcare. That's $10,345 per individual in America. Our health budget could be considered the fourth largest economy in the world. What we have to do is we have to take control. And how do you take control? First, remember the first rule. Don't ever lose money. Now, what could you have done? You could have put your money into a fixed rate annuity from 2000 that would have given you, at minimum, the same rate of return that the stock market did. Now, what else would this accomplish? You would have avoided the negative. You would have avoided the volatility. So when everybody else's funds and investments and retirements went negative and lost money, yours didn't lose money. It just stayed there. It stayed flat. And when the market came back, yours started growing again. So you started at a higher point than they did. What else could this have done? This could have given you liquidity so that when the market tanked, you could have took money out of your annuity, bought low, and then when you were happy with the amount of return you got when it came back, took that back out, put it back into your annuity, and waited to do it all over again. You could have done this repeatedly. If you look historically, and we've documented it for you, how many times the market's taken a dive since 2000, and you would have killed the rates of return that anybody else would have gotten. What else could you have done? Maybe you don't like annuities. Cash value life insurance would have done the exact same thing. And we're talking fixed products though, not variable life. And even if you just match the market, say you only got the exact same return, you're still coming ahead because guess what? Those gains that you got are actually tax-free. The gains that you're getting in your retirement fund, they're tax deferred. You're going to pay taxes on them. And with all the stuff that's coming down the hill, all the snowball effect that's coming, those tax rates are going to be a lot higher, not lower. Again, no losses and only going up when the market goes up. And it's all legal and in the tax code to make your gains tax-free. You have to learn how to beat the market. Now, what else could get you earnings besides annuities and cash value life insurance? Real estate, of course. Appreciation has been killing the market. But how does it work when the market crashes, the real estate market crashes? If you're invested in rental properties, guess what? Your money's still going to grow, and your rate of return is going to get bigger and bigger every year because you can predict how much you can raise somebody's rents by. So what if your value declines because your cash in hand keeps growing? So your cash on cash rate of return still keeps getting better and better, regardless what your appreciation or value of the property is. It's all about planning the right purchases for the right reasons. You got to have balance. At the end of the day, there isn't a one size fits all. There's a one size fits you. And you have to work with people, and you have to be those kind of people that can educate people on what they need to do. You can't be scared to know more than what it takes to know just to buy and sell houses. Because you wouldn't want to work with somebody who's limited in their knowledge. So why should you want somebody else to work with somebody who's limited in their knowledge? What I hope that everybody gets from this is that it's no longer okay to just be a real estate agent or real estate professional. We have to do more. And if you don't want to learn this information, then create a team that briefs you on this information that you can trust, that you can relay the information and relay your clients to. You don't all have to be crazy like me and go get licenses and learn all this information, but you do have to be knowledgeable and you do have to be aggressive. And if you want to plan for your own retirement, you need to sit down with somebody yourselves, like myself or someone else, that can get you where you want to be. And don't just believe the passive investing mentality of let's just set it here and in the long run it'll be okay, because it won't be okay. Thank you, and I hope that all of you found value from this.